Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional and owner of Shepherd Wealth Management. Very excited to be joining you all today for today's podcast. We got some really good topics. We're going to go over some earnings information. We're right in the middle of Q2 earnings season here for 2022. I want to talk a little bit about the energy sector itself. It's definitely the hottest sector of the market by a very wide margin. And I definitely want to get into a topic that we haven't had a conversation about yet with our watchers and listeners for this year, and that being the upcoming midterm elections. So what you can anticipate as far as the market's concerned, both before the election as well as after. And we're also going to take some live texts from our viewers here. So if you have a question as we go through some of these topics, definitely send us a text message, 513-630-2664. So we got a lot to cover here today, Ezra. Very excited, but before we even do that, happy birthday, man. It's your birthday today.
Oh, thank you. Yeah. An anniversary of my trip around Saul. Yeah. So it's exciting.
Yeah, no, I think it is. And I'm glad that you had a birthday. I know we'll do a little celebrating here in a little while. Unfortunately, this is actually black coffee. We can't do the, Manhattans here at the moment because it's, 10:30 in the morning here.
Yeah. Closing bell. We'll turn it up.
Yep. I got a couple of things to do today, including, side note, before we get into the show.
Yeah, tell the people.
I'll be spending about an hour speaking with the Cincinnati Alzheimer's chapter at 6 o'clock tonight, right here in Florence. And if you have a loved one, family member, or just want to learn some more information about how to handle your financial situation during those types of events, that's what we'll be talking about. So I'm looking forward to doing that as well. And then hopefully after that, we'll have a little good time, celebrate your birthday.
Yeah, that'd be great.
Yeah, man.
Looking forward to the sour beers and the fish sandwich.
I can already taste it.
Yeah.
But let's start with earnings, right? We're right in the middle of earnings season here, actually the very beginning of earnings season for Q2 2022. We've already had banks come out and announce their earnings. We've had Lockheed Martin recently come out and announce their earnings. And we got a whole list of other companies that are going to be coming out here with their reports for earnings that they had in Q1, and we'll see what they look like, but so far so good here. So I wanted to start with this particular topic, obviously, because over the long run, earnings are the most important thing to move the market forward from a growth standpoint. So that's where I wanted to begin here. I got a little bit of data. Of course, you got to come here prepared for these types of shows that we do on the podcast. And FactSets, it's a very reputable company. Really all they do is provide a really excellent piece of research and data. So as of March 31st, there were 10,821 ratings on stocks in the S&P 500. Of those ratings, 57.3 were buy ratings, 37.1 were hold ratings, and only 5.6 were sell ratings. The interesting part about this, and this is their analyst ratings right at the end of Q1. So as we're coming into Q2 earnings season here, which is why I think this data is actually helpful, is over the past 5 years, the average month-end percentage of buy ratings was 52.9. So we're above the average, and the average percent of hold ratings was 41.1. So we're well above these averages. And the interesting part here is the month of March marked the second highest percentage of buy ratings for the index going back to at least 2010. So a lot of analysts here, even though there's a whole bunch of sentiment, bearish sentiment, everybody's worried about inflation, everybody's obviously concerned about the geopolitical events that are going on in Ukraine, just the market's been trading on headlines, I feel like, good or bad. So if you get bad headlines, of course, the market seems to take that negatively and vice versa. But all these analysts are still looking at things from, I think, a logical perspective in that cash is a guaranteed loss because you're losing purchasing power due to inflation, being at 40-year highs at around 8% and likely going to continue to go up because even as the Fed increases rates, they have no control over the price of commodities and oil, which we'll be talking about here in a little bit as well. So you're likely to see inflation stay high. And if you go into bonds, interest rates are going up, so you're also guaranteed a loss there as well. So really, where else are you going to go other than U.S. equities, which is why I believe, other than the fact that earnings have been good and should continue to be good here as we continue to go through earnings season, where else are you really going to be able to long-term fight inflation, actually see positive growth out of your portfolio? I think that's why you're seeing the types of numbers here from these analysts that we just kind of went over there. So When we get into the earnings itself, the data so far, and we're still very well in the early innings here of Q2 earnings. However, of the companies that have posted earnings so far, almost 79% of them have either met or exceeded analyst expectations on both the revenue and the bottom line earnings per share. And the most important thing about all of these earnings announcements that you're going to see analysts focus on is their forward guidance. So what are the CEOs, CFOs of these very large companies that are publicly traded? What are they saying about the outlook for the next couple quarters as we end the year 2022? Are we able to meet the demand growth? Is demand slowing at all? Are there other headwinds that are going to affect our operating profit margin? And those are the questions that analysts want answers to. And it's just as important as the actual results. Yeah, you beat revenue, you beat earnings, great. But what's the next couple quarters going to look like from your perspective right now? So this forward announcement or forward guidance that CEOs, CFOs provide is going to be every bit as important as the actual results that they share here with us. So Q2 earnings off to a great start. I expect it to be probably in this range. Maybe 80 to 85% of the S&P 500 companies should either meet or exceed analyst expectations. But the bigger point to that would be, what is their future outlook for guidance? So we'll have to all be paying attention and watching that. But as we do that, we are certainly going to be very keyed into the energy sector itself. Obviously, it has a very big impact on things like inflation, which likely will be sticky here for the foreseeable future. But what we're looking at here from an energy performance perspective, the energy space itself is up like 46%. It's a
That's insane.
Very, very hot segment of the market here. And it's not just oil and natural gas. So the other big one, I don't know if you saw this or not, as I know this isn't like your day-to-day thing, but of all the things that you could possibly imagine in the commodity space that has done exceptionally well, fertilizer.
Fertilizer.
Yeah. Let that soak in for a minute, like fertilizer. As obviously as part of that.
Fertilize. Hold on.
Yeah. So as an example, Mosaic, MOS is a ticker symbol. That's pretty much what they focus their time and efforts on. They're up 94% year to date, right? So the commodity, very widely traded, XLE is a ticker symbol. It's just a whole bunch of oil energy types of companies in there. That's up 42% so far this year, which makes sense, right? If the energy sector itself is up 46%, if you're in an indexed ETF that's tracking those companies, you're going to be right in line or very close to that.
Right.
Even uranium, which is actually an ETF holding for some clients here at Shepherd Wealth Management, that's up 12% year to date. So a lot of the overall market itself, in Q1, the NASDAQ was down about 12%. The Russell was down around the same level. S&P 500 was down 6% in Q1 of 2022. But there are pockets of the market, and specifically energy and commodities is just hockey stick up and to the right. All these companies are trading at 52-week highs, and it seems like they hit a new all-time high every single day. So we're going to talk maybe a little bit more about that. I'm sure there could be a question or two from the audience watching and listening. So if you do have those questions about what my perspective is on the energy space itself and how we're positioning clients there, definitely reach out, 513-630-2664. So I'm sure we'll have more to talk about in the energy space here. But wanted to transition to, I think, a bigger topic for the remainder of this year, hopefully the bigger topic. I think a lot of people want to see this geopolitical thing kind of be resolved, and I know all the folks over in Ukraine do as well, but I think what we're really going to see in the headline news, as well as all the commercials between sporting events and all that good stuff, is going to be all about this midterm election that's coming up here in the next couple months. So that's where we want to transition this conversation to now, because I do believe that is going to be a big question on a lot of people's minds, and really what's going to be in their face as they're watching their favorite programs throughout the remainder of this year. So what does history have to say when it comes to midterm election years? So I wanted to start out from a volatility perspective for just a second. And this is going back all the way since 1970. Midterm years have a median standard deviation of returns of 15%, which is 2% higher than all other years. So standard deviation, for those folks that may not have ever taken a statistics class, or that's not really your cup of tea, All that simply means is if you have an average return of, let's say, 10%, and your standard deviation is 15%, well, that performance can deviate 15 percentage points plus or minus the actual average. So there's a very quick definition of standard deviation. But the important point here is that it's 2 percentage points higher going back all the way to 1970 than all other years. So really what that's telling you is you should expect for the next couple of quarters here, Q2, Q3, and maybe even the beginning part of Q4, you're going to see a lot more volatility than what you would otherwise typically see in a non-midterm election type of year. But also you're throwing on top of that 40-year high inflation. Federal Reserve is tightening due to their increases in short-term Fed funds rate. So every year is obviously different, and past information doesn't guarantee some sort of future result here. But I think what we can take away from the data set is to expect the market to be more volatile. And that expectation can help you control your temperament. So I got more data to share here as we continue this conversation about midterm elections. But I get the question all the time from clients, right? Because we talk, I quote Warren Buffett regularly. And one of his big things that he's always said for like the last 60 plus years that he's been managing money for folks as a profession is that he would rather hire somebody with a high level of temperament, like excellent control over their mental state, rather than somebody with a whole bunch of intelligence, because he can teach them, all the things that he knows about investing in publicly traded and private equity types of businesses. But the one thing that is a very difficult thing to teach is temperament. So how do I deal with my own temperament as I'm managing $35 million for clients and assets and growing on a regular basis? First thing I do is I remind myself of all the things, all the tenets that Buffett has, shared with the whole world for anybody that's willing to listen to him over the last 60 years. So maybe I'll pull out some Buffett books of mine that are favorites, and I'll read through some chapters. But the main thing that's helped me out from my own, temperament, mental standpoint, when the market's super volatile like it has so far this year, and other points in time in history when I've helped clients out and things have been very volatile, I always go back to reading. I want more information. So the Fed chairman, Jerome Powell, talks about how he wants to be data dependent. He's going to try to make all of his decisions based on actual data as opposed to, his gut feeling of what he thinks inflation is going to look like and how he can potentially reduce inflation through his activities. He wants the data to drive those decisions. What I want to do to help myself control my emotions, my temperament when it comes to managing money for clients as in my profession is I want to get a whole bunch of information. And it starts with doing this simple sort of research. Like, this isn't rocket science here. I went to Google and I said, midterm election, stock market, right? And you just start reading and finding this information out. Like, it's not rocket science. You just have to be willing to spend the time to know what's actually being explained here through all the data, going back to really as far back as you want to go.
Right. That's the old pandemic research, right?
Yeah, I find myself
sitting on the toilet, seeing if this vaccine is going to turn me into an alligator.
Yeah, I mean, you actually have to take I know this sounds very simple, but like a deep breath and like, hey, this is not the end of the world. You can't bet on that, like we talked about before. I mean, there could for sure be an end of the world scenario one day. Maybe I'm around, maybe I'm not for that. But even if you do bet on that as an investor, like, you're only going to be right once. And then there really won't be anybody to collect from.
Yeah, right. I was going to say.
So there's not much point of putting your energy into all of that. Right. Go ahead.
I was going to say, obviously, we crack jokes over here for a little bit of levity, just to, finance can be a very anxiety riddled subject, especially personal finance. But, there is something to be said about following data in real time. As markets play themselves out, you can see historical, correlations that they're irrefutable. It's not like your opinion if the market was up or down after a certain political event or at this time of the year, and you compare it to now. So it's so important for investors.
For sure. Now I can go into these earnings, right? Like I can do my homework. I can do all my own homework on publicly traded companies. All that data is out there for everybody to go look at and find with a simple Google search. Right. Or wherever you're holding your funds at, whatever brokerage house is going to have information for you there for any company that you can publicly trade, right? That's simple to be able to do. But when you do this extra due diligence with all these headlines, like to me, because I've done all the homework up front, I don't understand why a lot of people, get so emotional with their investments. Like, oh man, we're in a midterm election year. I'm going to go sell my Apple.
Right.
Like, really? You're going to go? That midterm election vote is causing you to sell your Apple stock. Like, that's not a tangible reason to me to do that. What I want to know is, what has history shown us in the past? So right now, it's going to be volatile. What does that mean? That means I need to have some assets in the portfolio, whether it's cash equivalent, or something that's just not correlated with stocks, as a asset class that I can easily sell when these volatile moments happen. I'm going to use that capital to invest in equities that I believe will have long-term growth prospects for my clients. Like, that's what I'm preparing myself for mentally. Okay, expect volatility, expect earnings to be good. A lot can change between now and the actual midterm, so I got to keep educating myself and reviewing the data. But the good news is, if you continue to do this sort of research, what we're also seeing is that the market after the election is very, very positive. And more often than not, markets bounce back strongly after U.S. elections are over. So the data that we have here is markets typically rally shortly after midterm elections. History shows that this isn't usually a short-term blip either, as above average returns are typical for the full year following the election cycle. Since 1950, the average one-year return following a midterm election is 15.1%, more than double that of all other years during a similar period of time. So yeah, expect a lot of volatility, but if your temperament is in check because you've done this research, you understand what these companies' earnings should look like, and then you have an idea of, okay, if I rebalance my portfolio into positions that have been the most oversold, and so far this year it's definitely been technology and some other sectors of the market, but technology has definitely been a big loser. The Russell 2000, I think your small caps have definitely underperformed the S&P. So I'm going to have something in the portfolio, whether it's using defensive names like your Lockheed Martins, your United Health, because everybody's paying their insurance premiums because of the geopolitical event. People and countries are spending more money on defending themselves and arming themselves with the right type of equipment. I can use some of those and some other positions that just aren't correlated with stocks at all, and cash equivalents, those types of things. And I know when I get this volatility, I'm going to go ahead and sell the things that are not correlated with stocks. I'm going to buy into the market dip. And based on history, I should expect a pretty solid return from my clients in a not too distant future after this election. So it's not a guarantee by any means, but at least I understand the probabilities that I'm working with here when we're coming into something as important as a midterm election, which who knows what the actual outcome is going to be. But from my seat here and doing all this research, it seems as though the main headline or the main talking point is going to be inflation. 40-year high inflation. We're at 40-year high inflation, and it's this administration's fault is what the blame is going to be, right? From whatever political aisle you rest in, that's going to be, I think, probably the main talking point, because whatever the Fed does between now and the actual midterm election, I really hope it reduces inflation. I mean, if we just saw inflation go down by 0.5% or 1%, like that would be a huge win for everybody and including all investors in the market. But my concern, and I've repeated this, I think a couple of times with clients in our quarterly reviews, is the Fed can raise rates as much as they want to, but there's a huge dislocation between supply and demand for energy, whether it's natural gas, whether it's oil, whether it's fertilizer, you name it. There's a huge dislocation between supply and demand. So I think the energy sector itself, even though it is trading at all-time highs, and it seems like it's doing that every single day, probably will sustain that type of growth for the foreseeable future, because the Fed can raise rates, but it really doesn't have an impact on something like the supply of fertilizer or the supply of oil or natural gas. So those are things that concern me from an investor standpoint, because inflation is going to be high. And we'll see how companies are able to pass along those inflated costs and protect their operating margins. I think a lot of them can, specifically the ones that we've decided to hold for clients here in our portfolios at Shepherd Wealth Management. But I'm not going to sell my Apple shares just because the headline says it's a midterm elections and things are going to be volatile. Like, slow down. Give me a call before you go sell your Apple shares. 513-630-2664. No joke, like literally half the time when I'm doing reviews with clients, when people call me, like half of my job is being a therapist, in all honesty.
Right.
So when we talk about temperament, I really believe this. I believe that probably 50% of the reason why people hire me, if not greater, I think it's at least 50 though, is that people have a difficult time controlling their own temperament. Like they know if they were left to their own devices, and they tell me this all the time. Like, I'll ask them questions before I started working with some of the clients I still work with. Well, I worked with a lot of them post 2008, right? We're sitting down 2009, 2010. And I'm asking them like, well, what'd you do when the worst thing that you've ever experienced as an investor actually happened? And they all talk about, they didn't use the word temperament, but they basically just said like, I let my emotions take control over my brain.
Yeah.
And I sold and I felt terrible about it. And that is unfortunately a lesson that a lot of investors have to go through. And a lot of these individuals just recognize that a big part of the role that I play is to be the guy that's going to help them with their own temperament, which is why I think it's so important to do quarterly reviews, because if you can't get that out of your mind, whether it's just bouncing it off of me or just sharing your own thoughts and emotions when things are as bad as they've been so far this year in the markets, it kind of helps people, get right back into the right type of temperament, even though they're not managing the portfolio. At least lets them feel better about, hey, I've gotten this off my chest. I've shared it with somebody that looks at this stuff on a daily basis, and we've actually had a conversation about it. Interesting story. I just did a quarterly review with a brand new client. And this gentleman is an older gentleman. He's in retirement. Excellent guy. Really enjoyed working with him so far. And he has a core and explore approach. So we talked about this with Raj, legendary coach and mentor Raj Gupta.
Regular on the show.
Yeah, well, he used to be. He just took a job at Vanguard, so I don't think we'll be allowed to use him too much anymore here. But this quarterly review, this individual had a core and explore approach. Core and explore meaning that the core of his portfolio was what I was managing, the money that he didn't want to see blow up in his face, wants consistent results from. The explore piece was a much smaller percentage of his liquid net worth, didn't really need the money, and he was taking more risk with that for the prospects of hopefully getting a better return. So that was his approach. So he had about, let's call it $50,000 that he was using to play around with some stocks. I was managing a much bigger number for him. And the goal is to see consistent long-term growth for what we're doing here at Shepherd Wealth Management, right?
Right.
We're controlling the asset allocation, the things we can't control. So we're sitting down our first quarterly review, and I've never worked with this guy at TD Ameritrade. Like he was a referral from a current client here at Shepherd Wealth Management, right? And
totally green, total new client.
Totally new. So it's his first quarterly review with me. And we sit down and, the very first thing that he says is like, hey, I'm in the black and you're in the red. Before we can even sit down and start talking about, what actually happened, the S&P was down 6.
That's an opener, isn't it?
Yeah, that was an opener. I was ready to go though. Like my temperament was in line. I was like, this is what I should anticipate happening here. This isn't my first rodeo. Now we were beating the indices. We beat the S&P, the NASDAQ, the Russell. So we were beating the indices. Everything was down. We were just a lot less down.
Right.
Which is that's the job, right? You're trying to make sure that we're losing a lot less than the overall market, or somebody that can just passively throw money into the S&P 500. Like my 13-year-old daughter can buy the SPY. Like that's not a very difficult strategy.
No.
Right. It's simple. So
those open calls, open puts, anyone can toss in on that.
Yeah, anybody can do that. So that's why we measure ourselves against those indices, even though it's not truly fair because of the way things are positioned, but that's what people want to see. So before I can even get to that, this guy's going, hey, I'm in the black, you're in the red, what gives? And I go, okay, well, of this 50,000, what types of positions do you have in here? And 40,000 of it was in like 2 energy positions, the bulk of it being Enbridge, which has done great. Definitely so far this year. Been a really good position for him. And I go, hey, do you maybe know why that is? Like, obviously you benefited from it, whether you did zero research and got super lucky, or you spent hours upon hours doing research to get these positions. You benefited. Like, let's throw that out the window. You don't even need to tell me if this is all luck. I think it kind of was.
Yeah.
Because when I asked the question, I was like, well, why do you think it's doing as well as it's doing? He's like, actually, I don't know. I'm like, well, this whole Russian-Ukraine thing has really caused, commodities to spike, and that's been the best performing sector so far this year. It was the best performing sector in 2021, even before we had this big geopolitical event on. And I go to him, we have the biggest sector weighting in your portfolio is tech, right? We're not 100% tech, but the biggest sector weighting is tech. And the reason for that is because, if you remember, we talked about you wanted long-term growth. That's really the biggest sector of the S&P 500. Therefore, if we want to have a chance of under or overperforming, we can't have as many positions or as big of a weighting, but we definitely need to pick our spots.
Right.
And I was using this as an actual example. And so I go, okay, let's pull up Enbridge. It's like, you're right. Year to date, crushing it. Absolutely knocking it out of the park, beating the S&P, NASDAQ, and Russell by even a bigger margin. And we pull up Apple, also looking at that quarter to date. Apple's down and to the right, like the exact opposite. And I was like, this is what happened. You're 100% right, Mr. Client. However, this is a long-term strategy, right? And he's like, yeah, absolutely. I was like, okay, let's just look at it Enbridge over a 5-year period of time. It's like, okay, so we pull it up, slow and steady, kind of up and to the right a little bit, gradual. I think the average return, the total return over that 5-year period was about 11% or so. So I'm like, okay, great. If we take an average, you're getting like 2.5% a year. Let's zoom out of Apple here for a second. We just looked at how bad Apple was on a quarter to date standpoint. Let's zoom out of Apple. Let's look at that over a 5-year period of time because that's fair, right? He's like, yeah. All right, well, the average return of Apple over 5 years has been like 79%. And I was just doing this as an example. It wasn't for me to, show him how much smarter or better or whatever. It was literally like the best way to control your temperament is to educate yourself. Go find the information. There's a reason why something's either up, down, or flat. Mm-hmm. There's a reason why certain sectors of the market tend to have much longer growth cycles than other sectors. Like this energy thing, that was the worst performing sector for like 15 years.
Right.
When everybody was like fracking, and then we had a lot more oil than we've ever had in the history of this country. And the demand for oil was what it was. Didn't really change, but the supply was so much greater than the demand. So what happened? Oil prices went down. All those companies that said, hey, let's just forget about how much it costs to drill. Let's just start drilling as fast as we can. A lot of those companies got absorbed by much larger energy players, right? A lot of them went out of business. That was the worst performing sector for a very, very long period of time while tech is going like hockey stick up and to the right with everything that Amazon and Microsoft and everybody else did, Google. So those are periods of times where it can be just a flash in the pan, right? 15 years, really terrible performance out of energy. Last year it was great, and now we get, a geopolitical event that even further spikes the dislocation in supply and demand for the energy space itself. So it's very interesting stuff when you get to have these conversations with individual investors on a quarterly basis. Is they have all the right intentions in the world. They're great people. Some of them are super smart, well-educated. Some of them maybe didn't even graduate high school, but created a business and were wildly successful. So a huge amount of admiration for the client that was sitting in front of me. So it's not a conversation of disrespect in any way, shape, or form. What I'm trying to do is to give them the education and the information, the actual data and results that I think that they may have either overlooked or didn't spend the time to go find for themselves. That way they can sit back and say, oh, okay, this is actually a construction of positions that are going to help me minimize the downside risk when things are very volatile, but still keep me in a position to absolutely be able to knock it out of the park and get more than my fair share of growth when inevitably we do get this recovery. And that was the point that I was trying to provide this gentleman. I think he got it because the rest of the conversation was awesome, even though it started out very tense.
Yeah. There was no more challenges being thrown.
Yeah, so he's still a client for all those watching and listening to this, and I think he will be for the foreseeable future here because he's a great guy. He just needed a little bit more information, and I think that helped his temperament because he went from, hey, what gives to, oh, I get it, we're cool, and I'm very, very excited to be working with you because I'm learning some things I may have not learned before.
Yeah, I mean that's a great story. A lot of people on the podcast, listeners, they don't get to see your daily interactions with clients. I mean, rightly so, that's private information, but that absolutely proves, I think, a fundamental of investing that a lot of people don't realize, and that is how important temperament is because everybody has access to the same information. Yeah. Right? There's not multiple, there's not multiple Dow chart. Everyone has the same information.
Yeah.
You may not know or understand how to apply the analysis. And if you've got enough money and you're just throwing it at meme stocks and buzzwords, eventually you're going to hit a home run.
Yeah.
But if you don't cash out and take advantage of that, and even if you do, what was the cost for all the strikeouts that you had?
Yeah.
So knowing when to, apply a temperament to every decision you make and how to go in and do the analysis of the market is so essential.
That's for sure. And those are the things that we can control. We can always control our temperament. I think the best way to do that, like we talked about here, is to get the information, read more, talk less. I think is the best phrase to summarize that. And the other part,
invest like the sky's falling.
Exactly. Never do that. And then I guess the last part of that is the other thing you can control is your asset allocation, the percentage of your money invested in all these sectors through the stock, bond, and commodity markets. So that's what we wanted to get to, but I think we got some text questions in here, Ez. Let's go ahead and take a couple of these while we still got some time.
All right. Yeah. Kate from Dayton was hopping in really early. The question is, should I sell the majority of my holdings, including tech, and buy commodities?
So it's a great question. I'm going through these quarterly reviews with clients right now. We're talking about performance, the energy space versus pretty much everything else. Almost everything else is in the red or close to it. Whereas the energy space is like a hockey stick up and to the right. And to me, it doesn't look like it's going to be slowing down anytime soon. So I completely get the urge the fear of missing out. And like I said, we're all hardwired with fear and greed going all the way back to caveman days. That's always going to be a part of a human being. So the greed factor starts to get in there. Like you can see this performance. And like I said, I don't think that it may change for several reasons that we might be getting into here in just a second. So first of all, I don't know the situation. Was it Kate?
Kate.
Don't know Kate's situation. So I'd have to learn a lot more about, how much of your money that you're actually considering making this change with, if it's all of it, if it's a portion of it. I don't know what her income is. So there's a lot I don't know about Kate's situation here. But to blankly say I should sell everything and buy energy and commodities, my clear answer to that is probably a no, right? Unless I knew a whole lot of other information for Kate. In this case, I don't. So I would never tell somebody, let's sell everything in all of these other investable sectors and let's just push it all into one sector. I don't think that's a good strategy. It's more of a trade than it is an investment. I am not a trader. I'm a long-term investor for clients. I want to help them see positive market performance to help them live the lifestyle they want to have, with them never having to worry about having to change that lifestyle regardless of what happens, who's president, what interest rates look like. So I'm a very long-term focused type of investor for my clients. So I would never tell them to do what Kate is asking me about here, but I think her real question is, in my opinion, I'm kind of looking a couple layers deeper here into her question, is she's probably made a lot of money on these tech stocks over the last several years, and she was probably under invested in commodities, right? Either with no exposure or very little exposure. Now she's seeing this shift in performance in her portfolio is probably what's really going on here. I think what you should consider though, Kate, like we just kind of went over here, the prospects for growth based on the history of what happens during midterm election cycles and what actually has happened during geopolitical events, like these things in the short run feel terrible and you will see the losses. But what I think you should consider doing is maybe what we are doing here at Shepherd Wealth Management is actually taking some of the profits from positions in the portfolio that have done well. A lot of it's been technology. Some of it's been more recent in the Berkshire Hathaways, the Lockheed Martins, United Health, those types of positions. So taking some profits off of that, but not selling all of those shares and simply just reallocating it to commodities. So we are building positions in commodities. So Mosaic, we talked about that one, the fertilizer. EQT is another one. It's up 100+% year to date. It's one of the largest natural gas producers and maybe the largest natural gas producer here in the United States. There's a whole bunch of others as well. We talked about XLE. We talked about the uranium ETF. So yeah, we are definitely building positions into these types of companies because we do want to benefit from the likelihood that we'll probably see elevated oil prices. We're likely to see elevated prices in natural gas for the remainder of the year. Just simply put, there's not enough supply of any of these commodities to meet all of the demand. Now, yeah, I mean, OPEC can come out and say, yeah, we'll pump more oil, but why would they? Right? I mean, if the whole world's trying to go, zero carbon emissions and we're going to have electric vehicles, well, there's still not they may be able to make a plane fly on hydrogen, right? I mean, that could happen, I guess, at some point, or some other invention may come about. But if they're able to keep the price of oil at a very, very profitable level and not really get too many people angry at them, specifically the United States, then why would they? I mean, I completely get it. It's their country, it's their oil, and they get to make those decisions. That's what this is about.
Yeah, if you're living off your backlog, that's everyone's dream, right? That's basically your retirement.
So here's the last part to that answer, and this is why I think you should rebalance as opposed to just dumping it all in, even though I'm maybe even building a more of a case as to why these positions are likely to do well for an extended period of time. But when you get this inevitable recovery, tech is going to be a huge part of it. I don't think you want to miss out on that. But I think the other reason why this energy commodity growth experience that we've been on and probably will be on for a while is simply put like the natural gas issue that they're dealing with over there in Europe. All these countries, not just Europe, but United States, all these major, developed countries are trying to figure out a way to be energy independent. That's probably top of mind, as well as being able to protect themselves, right, from the things that Russia's doing in Ukraine. So because of that, you're going to see a ton of investment into all of these different spaces: natural gas, fertilizer, agriculture, uranium, oil, all this stuff. Hydrogen is likely going to see some above average market growth for the foreseeable period of time. So I do agree with you, Kate, that is something, if you don't have exposure to, which a lot of people were underexposed to for a very long time, might be a good time to rebalance and consider doing what we're doing here at Shepherd Wealth Management. So it's a good question, and I understand the need and the greed aspect of wanting to go all in, but probably not a great strategy. But give me a call. I'd love to learn more about your situation, and I can give you more specific advice. Yeah. What else we got, Ez?
Looks like we got time for one more, so we're going to pick up Brian's texting back in. I don't think Brian has missed a podcast yet. So
Brian, how's it going? Thanks for all the texts, man. Appreciate it.
Here in Cincinnati. So Brian's question is this: my insurance rep and I were discussing how volatile the market is, and they suggested I buy into an annuity. What is your position on annuities, and is this a good idea? I don't think we've
I love
about that yet.
It's just surprising. It used to be like every other day I feel like I got an annuity question for a long time. And here's what I'll say, Brian. Again, appreciate the question. This is a really good question, actually. We probably should do a more in-depth discussion about annuities at some point, but future podcast. So here's my stance on this, Brian. I look at annuities like a tool. Depending on the job, it could be a great tool to have at your disposal. And for a lot of you, it's just a tool you just simply won't need. So here's my perspective on annuities in general, and then I'll get to your question specifically. My experience, and I worked at Fidelity for a period of time, TD Ameritrade, I've definitely had points in time where annuities made some sense for clients. But here's my actual experience with it. Because when you work at Fidelity, TD Ameritrade, any of these big companies, Wells Fargo, pick your favorite bank, I have friends in the industry and they work in all these different places. And what I know is this. I am a RIA, Registered Investment Advisor. I'm a certified financial planner. I'm a fiduciary. I don't get paid based on what any of my clients are invested in, so I sell no commission products. But when I did work for TD Ameritrade, Fidelity, and like I said, friends that work at banks and all this, other financial institutions, they're working on suitability. What does that mean? That means when you walk in, say, hey, this is the problem I'm trying to solve. And they say, okay, great. We got to capture your suitability. Due to regulatory requirements, it is a requirement. We do take suitability notes here, but when you are working at a company like a TD Ameritrade, like I said, or Fidelity, or pick your favorite bank, the way that you answer those questions. So there's probably millions of clients between each and every one of these institutions. So let's say you're working at Fidelity and there's 7 million clients that have all filled out a suitability form. Well, depending on how you answer that, if you're a 7 out of 10, you get this 7 out of 10 portfolio recommendation, and some of that could be a partial into an annuity and some other investment approach, right? So those guys are selling products, and they're generating commissions for the company, and they get a percentage of that commission. So it's potentially suitable for a client, and they can show that to regulators, and they can show that to a client like, hey, based on all the other people that are just like you have answered this the same way, this was suitable for them. Sounds like it's going to be suitable for your situation. And it really could be. Like I said, I look at annuities like a tool. It could make a lot of sense for some people. But my actual experience with annuities is I've never, ever, ever had one person come up to me, whether I was, as a registered investment advisor now or when I was taking clients at TD Ameritrade, say, hey, look at this annuity that I got from Jackson National and how awesome it is. I love it. It's never happened. Okay. Yeah. Not one time. They're always looking at me like, how do I get out of this thing? And then they come to find there's a ton of fees and penalties and, they underperformed because of all the heavy fees are actually embedded into an annuity, which people don't actually, one, they don't understand it. And the reason why they don't understand it is because when you look at a prospectus for an annuity, it's like, reading the Old Testament. Like it's a lot of information. They're just simply not going to look at that. So my perspective, I've had a lot of investors have a really bad experience with annuities. There's a whole bunch of different types, so we don't have time to talk about today. Fixed, variable, indexed, linked, there's all kinds of things specifically to talk about with annuities, but there's a ton of fees. And my real honest perspective about it is, even though it is a tool, I could find spots where it makes a lot of sense for individuals. I'm talking to the Alzheimer's group tonight. That could be a situation pre-Alzheimer's. If that's a hereditary thing, right, that you're concerned with, it can make some sense there. If you're super, concerned about the skies falling and I just want clear protection for part of my money, it could make sense. But my true to God honest perspective about it is you're either a client that has too much money and doesn't need an annuity, or you don't have enough money to be invested in an annuity. So here's what I mean by that. An annuity is an entity. It does not have a heartbeat. It's not a human being. It's planning on being around forever.
Right.
So time is its by far and away greatest asset. Any dollars that go into an annuity, let's say at Jackson National, they're going to take that money and they're going to invest it long term. Again, it's planning on being around forever. And that human being that gave you that capital, let's say it's a life annuity, well, they know that you're going to die, right, at some point in time. And they got a lot of these really smart actuary, statistical people that can get really darn close to about how long you're going to live. Mm-hmm. So they know, okay, I've got X amount of dollars to invest for forever, and I'm going to have to pay this person out based on the contract X number of dollars every month beginning on this period. So I'm likely, doing this math calculation, going to have to pay this out over 17 years. Okay, what do I need to invest in? How do I need to allocate these dollars so I can generate a return that's significantly greater than the payout? And they're really good at doing that, right?
Right.
So that's what they're doing with your actual money. And if you have a lot of money, to my point, you either have too much money or not enough money to be invested in an annuity. If you have a lot of money, why don't you just create your own annuity? You can invest in all the same things that the annuity companies are investing in. Individual stocks, commodities, bonds, heavy amount of bonds, and preferred stocks is what they're generally investing in. Like all that stuff is available for you. Like if generating income is the goal, there's a really good chance I can build a stream of income for you without tying up your money into an annuity that you will never be able to get out of, or at least not be able to get out of with substantial fees and penalties. And the other side of that is, maybe you don't have a lot of money and you're concerned about X, Y, and Z happening. Well, the reality is if you take all that money and put it into an annuity, now you just have no liquidity. You have a pension payment. You created a pension for yourself. That is it.
Right.
Like if you need, 20 grand for whatever reason, whatever event may come up, now you don't have that liquidity. Now you have less options. And less options, to me, is going to put those people in a much more painful situation, because then you got to consider doing things that you really probably don't want to do. Like I might have to sell my house. I may have to take a reverse mortgage on my house. Like all these other things that probably are last-ditch efforts to solve a bigger problem, when all you really needed to do was probably diversify that portfolio, figure out a decent withdrawal rate that you can sustain with that type of money, and still be able to invest in, again, the same things that these annuity companies are able to invest in and generate the stream of income, and still give yourself the option of, okay, if I do have the big event, a big emergency, I still have some liquidity. I don't have to go, to the extreme of selling my house or, refinancing it. Now I have a mortgage payment in retirement when I haven't had a mortgage payment forever. Mm-hmm. So all of these things just give you more options. So that's a great question, Brian. I think this has kind of opened me up to the idea of maybe doing a broader discussion on different types of annuities, the risk, and some of the pros and cons. There are some okay things about annuities. Not all annuities are bad. Not all annuities salespeople are bad. But I've definitely seen a lot of really terrible stories too. when it comes to investing and stuff like that. So I appreciate the question. I understand where it's coming from, but it would not be a solution, definitely not the first solution to solving anybody's problem here at Shepherd Wealth Management.
Yeah, I think we definitely need to have a finance 101 on annuities in the future. Here, with the podcast, that's not a word that gets tracked around too much now, but it's kind of starting to creep back up, I think, into the zeitgeist as far as
yeah, I mean it does when things are volatile, right? It's when everybody's fear and is very high and their sentiment is very bearish, you see a flood of annuity contracts being sold by insurance companies.
Right, yeah. I mean, 2008, right? That was it. It was those things I feel like were popping out of the woodworks too, people trying to get,
I mean, when we had, conversations with clients at Fidelity, I sold some annuities there. When people were bringing up, hey, I'm afraid, we could do retirement plans till the cows come home. But if that didn't make them feel any better, like, hey, we ran 1,000 Monte Carlo simulation on the way that your portfolio is constructed, and you're still going to be in a very high probability of being able to sustain the lifestyle you want. Like I can't get more scientific than that.
Right.
But they're not thinking logically. They're thinking with their emotions and, the FOMO and all that sort of stuff. And annuity is really the only solution for some people. And they really have to consider all the pros and cons before doing that. And I always looked at it as a last ditch solution to solve a problem for somebody. But I believe that those individuals may have buyer remorse, just like everybody else I've ever spoken with that actually has an annuity. There's probably another way to go about solving that problem, but they let their emotions dictate, the decision making in the moment. But the problem is you signed an annuity contract that could be for the rest of your life.
Yeah. Yeah. There's just so many more options around now for investors.
Yeah.
And talking to someone that, like as you mentioned earlier in the podcast, you may not possess the temperament, but trusting your financial planner.
And that's the big word. And that's the hard part, is that trust word. I mean, there's a lot of trust building that goes along with my clients. And that's why we communicate regularly with them. That's why we send out monthly newsletters. That's why I make myself available 24 hours a day, 7 days a week. Although I'd appreciate not getting a phone call between midnight and 5 a.m., just a little bit of sleep before I got to get up and get back at it there. But no, in all seriousness, if I make myself available and I can share this type of information, my actual experience with other clients, that are going through the same types of questions that you're probably experiencing at home, Brian and Kate and everybody else that's called and texted them with questions, like that is what people need to help control their temperament, is the data, the information, the experience, of what other people have kind of went through when they've had similar types of thoughts and questions and, positions that they need to consider the pros and cons of. So it's a great conversation. I do think you're right, Ez. We probably should have a full-blown annuity podcast here in the upcoming future. But that's all the time we got for today. So this was great. I really enjoyed going through, what's happened so far with earnings, what the energy and commodities sector has really done, and what it likely could potentially continue to do for the remainder of this year. And of course, we spent a decent amount of time talking about the midterm election, what actually has happened in prior history, and what you can potentially anticipate something similar happening here in the not too distant future as we approach the midterm election season. And of course, always love the questions from clients and just fans of the show. So if you liked it, definitely go to my website, shepherdwm.com. There's a whole bunch of information about my background and experience on the webpage there, but you'll also find at the very top of the website a link to our YouTube channel so you can watch the actual podcast shows. There also is a link to our Spotify channel so you can download the show, listen to it audibly as you're driving around. And don't forget to follow, Shepherd Wealth Management on Facebook, Instagram, and Twitter. My name is Joshua Casey Garland, Certified Financial Planning Professional. Saying thank you for watching, and I hope you guys have a great rest of your day.